Capital budgeting is like deciding which big projects a company should invest in. It helps figure out if things like buying new machines, building new factories, or starting new products are a good idea. Here are the key points. What is capital budgeting? It's the process of deciding if long term investments, like buying things or starting projects, are a good choice for a company. Methods to decide. There are different ways to make this decision. Some common methods are net present value (NPV), internal rate of return (IRR), payback period, profitability index, equivalent annuity, and real options analysis. Net present value (NPV). This method looks at the future cash a project will generate and tells you if it's worth it when considering today's money value. It considers time and risk. Internal rate of return (IRR). IRR is like finding the interest rate that makes a project's value zero, but it may not be the best choice when projects compete with each other. Payback period. It tells you how long it takes to get back the money you invested in a project. Shorter payback periods are usually better, but it doesn't consider time value of money or risk. Profitability index. This ratio shows how much value you get for each dollar you invest in a project. A higher index is better. Equivalent annuity. It turns a project's value into an annual payment, which helps compare projects with different lifetimes. Real options analysis. This method considers that managers can make smart decisions in the future to make a project more profitable. It's like giving credit for being flexible. Remember, you might use more than one method to make sure you're making the best choices for your company's big investments. It's like using different tools to get the job done right. Two major methods used in capital budgeting are net present value (NPV) and internal rate of return (IRR). Let's break them down. Net present value (NPV). NPV helps us figure out if a project is financially smart. It looks at all the money a project will make in the future and asks, is it worth that much money today? NPV considers the time it takes to get the money and how risky it is. Picking the right discount rate hurdle rate is crucial. It's like deciding how much interest you want when you invest your money. Managers use models like CAPM or APT to find the right discount rate. They also used WACC, which takes into account how the project is financed. Sometimes you might need a higher discount rate if a project is riskier than the company as a whole. Internal rate of return (IRR). IRR is like finding the magic interest rate that makes a project's value zero. It's a common way to see if an investment is efficient. When a project's cash flows start with spending money negative cash flow and then bring in more money positive cash flows, IRR usually agrees with NPV. However, when you have to choose between different projects, IRR might lead you to pick a project with less profit than the one NPV would choose. In simple terms, NPV helps us decide if a project will make us more money than it costs today, considering time and risk. IRR helps us find an interest rate that makes a project break even. But be careful with IRR when choosing between projects. It might not always pick the most profitable one. Modified internal rate of return (MIRR). Sometimes, people misunderstand the internal rate of return (IRR) as the actual yearly profit a project makes, which can be misleading. To avoid this confusion, we use MIRR. It corrects this problem and gives a more accurate picture of a project's profitability. Payback period. Payback period tells us how long it takes for an investment to pay for itself. Shorter payback periods are usually better because it means you'll get your money back sooner. But it has limitations because it doesn't consider things like the time value of money's value changing over time, risk, financing, or opportunity cost what you might lose by choosing one investment over another. Profitability index (PI). PI is a ratio that shows how much value a project creates for each dollar you invest in it. It's useful for comparing projects because it helps you see which one gives you more value for your money. Equivalent annuity. This method turns the net present value (NPV) of a project into an annual cash flow. It's handy when comparing projects with different lifespans. For example, if one project lasts 7 years and another lasts 11 years, you can't just compare their NPVs directly. Real options analysis. This method goes beyond just treating projects like bonds with known cash flows. It considers that managers can make choices in the future to increase cash coming in or reduce cash going out. Real options analysis tries to put a value on these choices and adds them to the NPV, giving credit to managers for being able to make smart decisions. In summary, these methods help you make smart decisions about big investments. They consider different aspects like time, risk, and the potential for making choices in the future to make investments even more profitable. Capital budgeting is like a company's way of making smart decisions about big projects. These projects can be anything from buying land to getting new trucks or machinery. Key points. Capital budgeting helps decide which projects are worth investing in. Companies use different methods to make these decisions, like payback period, internal rate of return (IRR), and net present value (NPV). Payback period. Payback period tells you how long it will take to get back the money you invested in a project. Shorter payback periods are better because you get your money back faster, but it doesn't consider important things like time value of money, risk, or opportunity cost. Internal rate of return (IRR). IRR is like finding the magic interest rate that makes a project break even. If IRR is higher than the cost of borrowing money, it's a good project. But it might not always pick the most profitable project when you have to choose between several. Net present value (NPV). NPV helps you figure out how profitable a project is compared to other options. It looks at all the money the project will make in the future, considering the time and risk. NPV is often the most effective method of the three. Why businesses need capital budgeting. Companies use capital budgeting to plan ahead and make sure they're spending their money wisely. It helps them understand the risks and returns of their investments. Businesses needed to be accountable to their owners or shareholders and stay competitive. Methods used in capital budgeting. There are different methods like discounted cash flow analysis. This method considers how the value of money changes over time and how project costs and income flow. Companies use various techniques to calculate target rates or cash flow figures to make smart investment decisions. In simple terms, capital budgeting helps companies make decisions about big projects. They use methods like payback period, IRR, and NPV to figure out which projects are worth their money and time. It's like making sure you spend your savings on things that will make you more money in the long run. Payback analysis is a way of deciding whether a project is worth it by looking at when it pays for itself or earns a certain amount of profit. Instead of just looking at dollars and returns, it's more focused on timing. Timing matters. Some companies want to know when a project will break even or earn a certain amount of profit. Careful forecasting. Predicting cash flows accurately is crucial because even a small change from year to year can affect when a company hits its payback goal. Throughput analysis is a different way of looking at capital budgeting. It doesn't just focus on specific projects but looks at the entire organization, including revenue and expenses. Revenue versus variable costs. It calculates how much profit each sale brings in after subtracting variable costs. Once all fixed costs are covered, the remaining profit belongs to the company. Funding operations. Companies often use this method to ensure they not only make a profit, but also have enough capital left after covering variable costs to support their operations. Metrics used in capital budgeting. When companies need to decide if a project will be profitable, they use different metrics. The three common ones are payback period, internal rate of return (IRR), and net present value (NPV). Payback period (PB). It tells you how long it takes for a project to earn back the initial investment. A shorter payback period is better. However, it doesn't consider the time value of money, making it less precise. Internal rate of return (IRR). It's the expected return on a project. If IRR is higher than the cost of capital, it's a good project, but it can sometimes give different results than NPV. Net present value (NPV). This method looks at all future cash flows, considering time and risk. It's often the most effective method for making decisions. In simple terms, capital budgeting helps companies make smart choices about projects. Payback analysis focuses on when a project becomes profitable, while throughput analysis looks at how projects contribute to the company's overall profit. Different metrics like payback period, IRR, and NPV help companies decide which projects are worth their money. Payback analysis is a way of looking at when you'll get your money back from a project. Some companies want to know when they'll break even or earn a certain amount of profit from a project. To do this, you need to be really careful in guessing when you'll get money in and how much. If you make a small mistake in your guess, it can change when you'll reach your payback goal. Throughput analysis, on the other hand, is a different approach. Instead of just focusing on one project, it looks at the whole company's revenue and expenses. It's like counting all the money that comes in and subtracting the costs that change when you make a sale. Once you've covered all your fixed costs that stay the same no matter how much you sell, the money you make goes to the company as profit. Some companies don't just want to make profit, they also want to have a certain amount of money left over after paying for variable costs that change with sales. This leftover money can be used for other things, like covering day-to-day expenses. Metrics used in capital budgeting. When companies have to decide if a project is worth doing, they use different ways to see if it's going to make money. The three common ways are the payback period, the internal rate of return IRR, and the net present value NPV. Payback period tells you how long it will take to get your initial investment back from the project's earnings. IRR is like finding an interest rate where your project's value becomes zero. If it's higher than the cost of borrowing money, it's a good project. NPV helps you see how profitable a project will be compared to other options. It looks at all the money the project will make in the future, considering the time and risk. Advantages and disadvantages of these metrics. Payback period is simple and tells you when you'll get your money back, which is good for companies with limited funds. However, it doesn't consider the time value of money, how the value of money changes over time, and doesn't look at cash flows towards the end of the project. IRR is good for knowing if a project is profitable, but it can sometimes give the wrong answer when comparing multiple projects. NPV is often the best because it considers all the cash flows and time value of money. However, it can be complex. In simple terms, capital budgeting helps companies decide if a project will make money. Payback analysis looks at when they'll break even or make a certain profit, while throughput analysis sees how much profit comes from each sale. Companies use different metrics like payback period, IRR, and NPV to make these decisions, but each method has its pros and cons. Throughput analysis. Throughput analysis is quite different from other capital budgeting methods. It looks at the revenue and expenses of the whole company, not just specific projects. The focus is on how much profit each sale contributes to covering fixed costs. Once fixed costs are covered, any extra profit becomes company equity. Some companies not only aim for a certain level of profit, but also want to keep a certain amount of capital available after covering variable costs. This capital can be used for operational expenses. Metrics from throughput analysis help management decide how much capital budget projects need to contribute back to the company's operations. Metrics used in capital budgeting. When a company faces a capital budgeting decision whether to invest in a project, they use metrics to figure out if the project will be profitable. The three common metrics used are payback period (PB), internal rate of return (IRR), and net present value (NPV). PB tells you how long it takes to get back the initial investment. IRR is the expected return on a project. If it's higher than the cost of capital, the project is good. NPV helps you see how profitable a project is compared to other options. It considers the time value of money and risk. These metrics might give different results, so companies choose the one that matches their priorities and criteria. Payback period (PB). PB tells you how many years it will take for a project to pay for itself. Shorter PB is better because it means the project pays off faster. PB is used when a company's funds are limited and they can only do one project at a time. However, it doesn't consider the time value of money and ignores cash flows at the end of a project. Internal rate of return IRR. IRR is the discount rate that makes a project's net present value NPV zero. If IRR is higher than the cost of borrowing money, the project is profitable. IRR can be a good method, but it might not always choose the most profitable project when you have to choose between several. These methods help companies decide if a project is worth investing in. They look at different aspects like timing, profitability, and the value of money over time to make smart financial decisions. The net present value NPV rule is like a golden rule in finance. It says that when a company is deciding on a project, they should accept it if it has a positive NPV and reject it if it has a negative NPV. Here's how it works. NPV helps figure out if a project will make the company more money in the long run. If the NPV is positive, it means the project will bring in more money than it costs, which is a good thing. But if the NPV is negative, it means the project will lose more money than it makes, so it's a bad idea. When a company has limited funds and can't do all the positive NPV projects, they should pick the ones with the highest NPV because those will make them the most money. Example: let's say there are two projects, Project A and Project B. Project A has an NPV of $137,236, and Project B has an NPV of $1,317,856. Both projects are expected to increase the value of the company, but if the company only has $1 million to invest right now, they should choose Project B because it has the higher NPV. Advantages of NPV. It's a useful tool to measure profitability. You can compare different projects at the same time. It helps signal potential future problems if the discount rate, the rate used to calculate NPV, changes. Profitability Index PI is another metric that can help. It's calculated by dividing the present value of future cash flows by the initial investment. If PI is greater than 1, it means the NPV is positive, which is good. If it's less than 1, the NPV is negative, which is bad. Capital budgets are different from regular budgets called operational budgets because they're for long-term plans that can span many years, while operational budgets are usually for 1 year. Capital budgets focus on things like investments and major purchases, while operational budgets deal with day-to-day expenses. Companies aren't required to prepare capital budgets, but they're crucial for planning and long-term success. They help companies make smart decisions about big investments by using methods like NPV, IRR, and payback periods to make sure the return meets their expectations. Net present value NPV rule. NPV is a way to figure out if a project will make a company more money than it costs. The NPV rule says that if a project has a positive NPV, it's a good investment and the company should accept it. If a project has a negative NPV, it's not a good idea and the company should reject it. When a company has limited funds and can't do all the positive NPV projects, they should choose the ones with the highest NPVs. NPV tells you how much a project adds to the company's overall value. Advantages of NPV. NPV is super useful because it shows how much profit a project will add. You can compare many projects at once to see which ones are best. Even if interest rates change, NPV can still tell you if a project is worth it. The Profitability Index PI can fix any concerns about the project's size compared to NPV. PI is like NPV but shows how big the project is compared to the initial investment. Capital budgets versus operational budgets. Capital budgets are about planning for big long-term stuff like investments, developments, or major purchases. Operational budgets are for short-term planning, usually just 1 year. They focus on day-to-day income and expenses. Are companies required to prepare capital budgets? No, companies don't have to prepare capital budgets. They're mainly for the company's use and not public disclosure. But capital budgets are super important for a company's long-term success and help with smart decision-making. Summary. Capital budgets plan for big things a company wants to do, like investments or buying stuff. The NPV rule helps decide if these big plans will make money or not. NPV is great because it tells you how much profit a project adds. You can compare many projects to choose the best ones. Capital budgets are different from short term budgets, and companies aren't required to make them, but they're really helpful. Goals of capital budgeting. Capital budgeting helps a company plan for the long term and decide where to invest its money. The main goals are ranking projects and raising funds for these big investments. Ranking projects. Capital budgeting helps a company decide which big projects to do. There are usually many projects to choose from, and capital budgeting helps rank them from the most profitable to the least. The best projects are done first until the budgeted money runs out. Raising funds. When a company decides to do a big project, it needs money. It can get money through corporate bonds, preferred stock, or common stock. The mix of these sources depends on how much financial risk the company is willing to take. Importance of capital budgeting. Capital budgeting is super important because it involves a lot of money and long-term decisions. Once a company invests in something big, it can't easily change its mind without losing a lot of money. Long-term decisions are riskier and more uncertain than short-term ones. Summary. Capital budgeting helps companies plan for big long-term investments. It ranks projects and helps decide where to get the money for them. It's crucial because it involves a lot of money and long-term commitments, and it's riskier than short-term decisions. Common terms to know. Common stock. This is a type of ownership in a company, like owning a piece of it. Preferred stock. It's a mix of stock ownership and debt, giving certain privileges to stockholders. Private equity. Companies like NBGI Private Equity provide funds to other companies that don't want to get money from the public. Capital budgeting and cash flows. Capital budgeting is about making smart financial decisions regarding investments and projects. To do this, you need to understand how money flows in and out of a business, which is where accounting principles come in. Accounting flows. Accounting is like the financial record-keeping system for a business. It's all about tracking the money that comes in and goes out. There are rules and standards like GAAP that guide how this is done. Different types of transactions affect different parts of a business's financial statements. Cash flows. Cash flows are a crucial part of accounting, especially in capital budgeting. Cash flow is all about tracking the actual money that moves in and out of a business. It's like following the real dollars as they come in and go out. Cash flow analysis helps determine if a project or investment is worth it. Types of cash flows. There are three main types of cash flows. Investing activities, money related to buying or selling assets, loans, and investments. Operating activities, money related to everyday business operations like buying materials, paying employees, and more. Financing activities, money from sources like loans or investments and money going out as dividends or debt payments. Why cash flows matter. Cash flow analysis helps figure out if a project will make money and how much. It calculates things like internal rate of return, IRR, and net present value, NPV. Cash flows also show how easily a business can seize opportunities by having enough cash on hand. It's a big part of understanding a business's overall financial health. Summary. Capital budgeting involves making wise financial decisions about investments and projects. To do this, you need to understand how money flows in and out of a business, which is where accounting and cash flow analysis come in. Cash flows are like tracking the real dollars, and they help determine if a project is profitable and how financially fit a business is. Ranking investment proposals made easy. When a company has multiple investment options, it needs to figure out which one is the best. To do this, it uses different methods. Net present value, NPV. NPV is like finding the difference between how much money you make and how much you spend, but it also considers the time value of money's worth over time. The higher the NPV, the better the investment. It's a way to see if the project will make you more money than it costs. Internal rate of return, IRR. IRR is like the interest rate that makes all the money you put into a project equal to all the money you get back. The higher the IRR, the more attractive the project. It helps you choose the project with the best return. Profitability Index PI. PI shows how much value you get for every dollar you invest. The higher the PI, the better. It's a quick way to compare projects. If the index is greater than 1, it's a good project. Payback period. Payback period is like asking how long it takes for your investment to pay for itself. Shorter payback periods are better because you get your money back sooner. Accounting rate of return ARR. ARR is a bit like PI, but it doesn't think about the time value of money. It tells you how much profit you get for every dollar you invest, without considering time. Summary. To pick the best investment, you can use NPV, IRR, PI, payback period, or ARR. Each method has its own way of looking at the investment, but they all help you make smart choices. Companies use these methods to decide which investment is the most attractive. They look at things like future profits, return rates, and how quickly they'll get their money back. The goal is to pick the best option that makes the most financial sense. Accounting rate of return, ARR, is a method used to evaluate the profitability of an investment. It calculates the return generated from the net income of a proposed capital investment as a percentage return. For example, if the ARR is 7%, it means the project is expected to earn 7 cents for every dollar invested. If the ARR is equal to or greater than the desired rate of return, the project is acceptable. Otherwise, it should be rejected. Pros. Simple. ARR is easy to understand and calculate, making it accessible for small businesses and individuals. Uses accounting numbers. It relies on accounting data, which is readily available and doesn't require complex financial projections. Percentage measure. It expresses profitability as a percentage, which is intuitive for decision makers. Cons. Ignores time value of money. ARR does not consider the time value of money, meaning it doesn't account for the fact that a dollar received in the future is worth less than a dollar received today. Doesn't account for project lifespan. It doesn't consider the lifespan of the investment, potentially leading to poor decisions for long-term projects. Ignores cash flow timing. ARR doesn't consider the timing of cash flows, which can be crucial for assessing an investment's risk. Importance. ARR is important because it provides a simple way to assess the potential return on an investment. It can be useful for quick, preliminary evaluations of investment opportunities. Small businesses and individuals often find it accessible for making investment decisions. However, it's essential to recognize its limitations, particularly regarding the time value of money and the project's lifespan. For more accurate evaluations, complementary methods like net present value NPV and internal rate of return IRR are often used alongside ARR. Costs to exclude from the project. Sunk costs. Sunk costs are costs that have already been incurred and cannot be recovered, regardless of the investment decision. Since these costs are in the past and cannot be changed, they should be excluded from the capital budgeting analysis. It means that any money spent on research, feasibility studies, or any other cost related to considering the investment should not be factored into the decision-making process. Fixed costs. Fixed costs are expenses that remain constant regardless of whether the project is undertaken or not. These costs are typically associated with the company's ongoing operations and are not directly tied to the specific investment decision being evaluated. Examples of fixed costs include rent, insurance, and salaries of employees not directly involved in the project. Importance of excluding these costs. Excluding sunk costs is important because they are irrelevant to the decision at hand. What matters is the future cash flows and costs associated with the investment, not the past expenses that cannot be changed or recovered. By excluding sunk costs, decision makers can focus on evaluating the potential future benefits and risks of the investment. Similarly, excluding fixed costs is necessary to ensure that the evaluation is centered on the incremental impact of the investment. Fixed costs will be incurred regardless of the investment decision, so they should not influence whether the project is viable or not. Example: should the company invest in robotic automation? Let's say a manufacturing company is considering investing in robotic automation to improve its production efficiency. The cost to include in the evaluation would be the purchase price of the robots and any additional expenses related to their adoption, such as installation and training costs. On the other hand, the company should exclude any sunk costs, such as money spent on market research or consultants to explore the feasibility of robotic automation. Additionally, fixed costs like factory rent and existing employee salaries should not be factored into the decision. By focusing on the relevant costs and excluding the irrelevant ones, the company can make a more informed investment decision based on the actual impact of adopting the robotic technology on its future cash flows and profitability. This allows for a clearer understanding of the potential benefits and risks associated with the investment, leading to better decision making. Costs to include: when you want to decide whether to buy a robot, you need to think about all the money you will spend if you adopt the project. The costs to include are: 1. Purchase price of the robots. This is the money you will spend to buy the robots in the first place. It's like how much you need to pay to bring the robots home. 2. Other costs incurred if project adopted. Besides the purchase price, there might be other costs that you will need to spend if you decide to adopt the robot project. For example, you might need to buy special equipment to use with the robots or pay for training to learn how to operate them. Costs to exclude. When making a decision, some costs are not relevant, and it's better not to consider them. These costs are: 1. Sunk costs. Sunk costs are costs that you have already spent in the past, and you can't get that money back. When deciding whether to buy the robots, you shouldn't think about any money you already spent, like if you had paid for a study about robots in the past. Those costs are history and can't be changed. 2. Fixed costs. Fixed costs are costs that will be incurred regardless of the decision you make. For example, if you decide to buy the robots, you will still need to pay for electricity and rent for your workshop, even if you didn't buy the robots. So, you don't consider these costs when deciding whether to adopt the project or not. Example: let's say you want to buy a robot for $500. Besides that, you might need to spend an additional $100 for tools and training if you decide to adopt the robot project. These are the costs to include in your decision. But if you already spent $50 in the past for a robot study, you don't include that cost because it's a sunk cost. Also, if you need to pay $200 per month for electricity and rent, you don't include that in the decision because it's a fixed cost. So, to make the best decision, you only focus on the costs you will spend if you buy the robot purchase price and other costs if adopted, and ignore the costs that are already spent sunk costs or the costs that will be there no matter what decision you make fixed costs. In summary, when making a decision about a project like buying a robot, you consider the costs you will spend if you adopt the project and exclude the costs that are already spent sunk costs or will be there regardless fixed costs. It's like looking at the right information to make a smart choice. Project cash flows. Project cash flows refer to the money that a company expects to receive or spend as a result of an investment project over its lifetime. These cash flows are crucial in evaluating the financial feasibility and profitability of the project. The process involves projecting the future net cash flows, determining the economic life of the investment, estimating yearly cash flows throughout that period, and considering any cash flows at the end of the project. 1. Project the economic life of the robots. The economic life of the robots is the estimated duration during which the robots will be useful and operational, providing benefits to the company. It represents the time over which the investment is expected to generate returns. Importance: determining the economic life is essential because it allows the company to understand how long the robots will be contributing to its operations and generating cash flows. If the economic life is overestimated, it may lead to unrealistic expectations, while underestimating it could result in missed opportunities for the company. 2. Project the yearly cash flows over that life. Yearly cash flows involve estimating the net cash inflows money coming in and outflows money going out for each year throughout the economic life of the robots. These cash flows consider revenues generated by the robots and any related expenses like maintenance and operating costs. Importance: projecting yearly cash flows is critical for assessing the financial performance of the investment over time. It helps the company understand the expected pattern of cash generation and identify periods of higher or lower cash flow, which aids in financial planning and decision making. Free. Project any end of project cash flows. End of project cash flows refer to the cash flows that occur at the end of the economic life of the robots. It includes any potential cash inflows or outflows related to the disposal or sale of the robots after they have served their purpose. Importance: considering end of project cash flows is essential for getting a complete view of the investment's overall financial impact. It helps determine the net value of the robots at the end of their useful life and accounts for any cash recovery or additional costs associated with their disposal. Factoring in these cash flows allows for a more accurate assessment of the investment's long-term profitability. Why projecting future cash flows is the most difficult. Projecting future cash flows is challenging because it requires making predictions about the future, which is inherently uncertain. Several factors contribute to this difficulty. Uncertain environment. The business environment is influenced by various factors such as market demand, economic conditions, and technological advancements, which are hard to predict with precision. Changing circumstances. Over the life of the project, circumstances may change, making it challenging to accurately anticipate future cash flows. External factors. Events like economic recessions, industry disruptions, or changes in regulations can significantly impact cash flows. Importance: despite the difficulty, projecting future cash flows is crucial for making informed investment decisions. It helps companies assess the potential returns and risks associated with an investment, allowing them to allocate resources wisely and maximize profitability. While uncertainties remain, careful analysis and consideration of various scenarios can aid in making more reliable cash flow projections. Regularly updating projections based on real-world data and market trends can improve accuracy and enhance decision-making. Projecting future cash flows. Imagine you have a magical robot that can help you make money every year. But just like any magic, we need to plan for the future and see how much money the robot can make and how much it will cost us. This is called projecting future cash flows. 1. Project the economic life of the robots. Think of the economic life as how long the magical robot can keep working effectively for your project. It's like knowing how many years you can use the robot to make money. Let's say the robot can work its magic for 5 years. That's its economic life. 2. Project the yearly cash flows over that life. Now let's see how much money the magic robot can make for you each year during its economic life. For example, maybe the robot can make you $100 each year by helping with tasks. But remember, the robot is not entirely free. It needs some care and maintenance, which might cost you $20 each year. So your net cash flow money made, costs for the first year would be $100. $20 equals $80. Free. Project any end of project cash flows. At the end of the economic life, there might be something special happening. Maybe you decide to sell the magic robot to someone else because they want to use its magic power. This would give you some extra money at the end of the project, called an end of project cash flow. Why it's difficult? Projecting future cash flows is like looking into a crystal ball and guessing what the future will be like. It's not easy because there are many things that can change. Maybe the magic robot works a little better than you expected, and you make more money, or maybe it needs more repairs, and you spend more money than you thought. It's like trying to predict the future, and that's why it's tricky. Simple example. Let's say you have a magic robot for a 4-year project. Each year, the robot helps you make $50, but it costs $15 for its upkeep and care. So, your net cash flow each year is $50. $15 equals $35. At the end of year 4, you decide to sell the robot to someone else, and they pay you an extra $100 for it. So your end of project cash flow is $100. In summary, projecting future cash flows is about planning how much money your magical robot can make each year and how much it will cost you. It's a bit like predicting the future, and even though it's tough, it helps you make smart decisions about your magical robot investment. Select an acceptance criteria. Alternative methods. When evaluating investment projects using alternative methods, companies typically use three common criteria: payback period, internal rate of return (IRR), and net present value (NPV). Each method provides a different perspective on the investment's feasibility and potential returns. 1. Payback period. The payback period is the time it takes for a company to recoup its initial investment in a project from the net cash inflows it generates. In other words, it measures how many years it will take to recover the cost of the investment. Importance. The payback period is important because it provides a simple measure of liquidity and risk. A shorter payback period is generally preferred as it indicates a quicker return of the investment, reducing the risk of capital tied up in the project. However, it does not consider cash flows beyond the payback period, so it may not capture the project's long-term profitability. 2. Internal rate of return (IRR). The internal rate of return (IRR) is the rate at which the present value of future cash inflows from the project equals the initial investment cost. In other words, it is the discount rate that makes the net present value (NPV) of the project zero. Importance. The IRR is crucial because it represents the project's rate of return, indicating its potential to generate a yield greater than the company's required minimum return. If the IRR is higher than the company's required rate of return, the project is considered financially attractive. However, the IRR method assumes that cash inflows can be reinvested at the IRR rate, which may not be realistic. 3. Net present value (NPV). Net present value (NPV) is the difference between the present value of cash inflows and outflows generated by the investment project. It discounts future cash flows back to their present value using a specified discount rate, usually the company's cost of capital. Importance. The NPV is important because it provides a comprehensive measure of the project's profitability. A positive NPV indicates that the project is expected to add value to the company, as the present value of cash inflows exceeds the cost of the investment. It considers all cash flows over the project's lifetime, providing a more accurate assessment of long-term profitability. Why these criteria are important. These acceptance criteria are essential because they help decision-makers evaluate investment projects in a systematic and consistent manner. By considering different perspectives, companies can make well-informed choices that align with their financial goals and risk tolerance. Payback period. The payback period is valuable for projects where quick returns are essential or when liquidity is a primary concern. It is often used for small-scale projects with short-term benefits. Internal rate of return (IRR). IRR is beneficial when comparing multiple investment opportunities. It allows companies to identify projects that offer higher rates of return, potentially maximizing overall profitability. Net present value (NPV). NPV is a comprehensive metric that accounts for the time value of money. It considers all cash flows and is particularly valuable for long-term projects, allowing companies to make better decisions that contribute to the growth and success of the business. A positive NPV indicates that the investment is expected to increase shareholder wealth. In summary, selecting the appropriate acceptance criteria helps businesses evaluate investment projects effectively. While each method has its advantages and limitations, considering multiple criteria provides a more holistic view, leading to better investment decisions and resource allocation. Selecting acceptance criteria. When you want to decide if a project is a good idea or not, you need some rules to help you make the right choice. These rules are like a guide to tell you if the project is worth doing or not. There are three common rules, and they have funny names: payback, internal rate of return IRR, and net present value NPV. Let's see what they mean. 1. Payback. How many years to recoup initial cost? Payback is like counting how many years it takes to get back the money you spent on the project. Imagine you lend your friend $100 and they promise to give you $20 every year until they pay you back in full. Payback is like asking, how many years will it take for my friend to give me back the $100? Example: let's say you invest $200 in a special project, and each year it makes you $50. You can find payback by dividing the initial cost $200 by the yearly cash flow $50. In this case, it will take 4 years to get back your $200. 2. Internal rate of return IRR is the yield greater than minimum required return. Internal rate of return IRR is like checking how good your investment is. It's like knowing the yield or how much profit you will make each year from the project. Think of it as a magic number that tells you how much money your project will grow. Example: let's say you have a project that costs $500 and each year it makes you $100. IRR is like finding out how much percent profit you make each year. In this case, the IRR is 20% because you make a 20% profit each year. 3. Net present value NPV. Is PV of cash inflows greater than cost of project? Net present value NPV is like looking at the future and seeing if your project will make more money than it costs. It's like knowing the value of your project in today's money. If NPV is positive, it means your project is a good investment. Example: let's say you have a project that costs $300 and it will make you $100 each year for the next 5 years. NPV is like adding up all those future cash flows and seeing if it's more than the cost of the project. In this case, the NPV is $50, which means your project will make you $50 more than what you spent. In summary, these three funny named rules, payback, IRR, and NPV, are like your helpers to decide if a project is good or not. They help you figure out how long it takes to get your money back, how much profit you will make each year, and if your project will make you more money than what you spent. It's like using a special calculator to see if your project is a success. Payback method. The payback method is a capital budgeting technique that determines how long it takes for an investment to recover its initial cost or the amount invested from the net cash inflows it generates over time. In this method, the investment project is accepted if the payback period is less than a specified cutoff target, which represents the maximum acceptable time to recoup the initial investment. Calculation of payback period. To calculate the payback period, we look at the cumulative net cash flows for each year until the total cash inflows equal or exceed the initial investment. The payback period is the time it takes for this to happen. Flaws of the payback method. Does not consider time value of money. The payback method does not take into account the time value of money, which means it treats cash inflows received in different years as equally valuable. In reality, money received today is worth more than the same amount received in the future due to inflation and the potential to earn returns on investment. Cut-off target is arbitrary. The selection of the cut-off target maximum acceptable payback period is arbitrary and does not consider the actual profitability or long-term value of the investment. Different companies may use different cutoff targets based on their risk appetite or other factors, leading to inconsistent decision-making. Importance of understanding the flaws. While the payback method has simplicity and provides a measure of liquidity, it has significant limitations. Time value of money. Ignoring the time value of money can lead to inaccurate assessments of an investment's true profitability. Projects with longer payback periods might be rejected, even if they have higher overall returns over the long term. Short-term focus. The payback method prioritizes early cash recovery, which may lead to the selection of projects with short-term benefits, but lower overall profitability. It neglects the potential of long-term projects that might generate substantial cash flows after the payback period. Inconsistent decision-making. The arbitrary nature of the cutoff target can lead to inconsistent acceptance or rejection of projects. Projects with similar characteristics might be accepted or rejected based solely on the chosen cutoff target. Additional considerations. While the payback method has its flaws, it may still be useful when assessing projects with short payback periods that require immediate liquidity or when the risks associated with the investment are uncertain. However, it is essential to complement the payback method with other capital budgeting techniques, such as the net present value NPV or internal rate of return IRR, which consider the time value of money and provide a more comprehensive evaluation of the investment's long-term profitability and value to the company. By using a combination of methods, businesses can make well-informed decisions that align with their financial goals and risk tolerance. Payback method. The payback method is like counting how many years it takes for a project to make enough money to cover the initial cost. It's a quick way to see when you'll get your money back from the project. Example: imagine you have a special project and you spent $500,000 to start it. Now, each year, the project makes some money. Let's see how much money it makes each year and how long it takes to get your money back. Year 1. The project makes $115,000, so you still have $385,000 left to get back. Year 2. The project makes $150,000, so you still have $235,000 left to get back. Year 3. The project makes $175,000, so you still have $60,000 left to get back. Year 4. The project makes another $175,000, and now you got back all your money. You spent $500,000 and got back $500,000 in 4 years. Payback term. The payback term is like the time it took to get your money back, and in this case, it's 4 years. Accept or reject. Now you can compare the payback term to a target time set by you or your company. If the target time is, let's say, 3 years, you would reject the project because it took longer than the target time to get your money back. But if the target time is 5 years, you would accept the project because it took less time than the target. Flaws of payback method. The payback method is simple, but it has some flaws. It doesn't think about the value of money changing over time like inflation, and it's just a quick estimate. Also, the target time can be decided without a solid reason, making it arbitrary. In summary, the payback method is like a quick way to see how long it takes to get your money back from a project. But it has some flaws, like not considering inflation and using an arbitrary target time. It's like checking how fast your investment pays off, but it's not the whole story. IRR method. The internal rate of return IRR is a capital budgeting technique used to assess the profitability and attractiveness of an investment project. It is the discount rate at which the net present value NPV of the project becomes zero. In other words, it is the interest rate that equates the present value of all future cash inflows from the project to the initial cost of the investment. Calculation of IRR. To find the IRR, we need to solve for the discount rate that makes the sum of the present values of all future cash inflows equal to the initial investment. This discount rate is the IRR. Adoption decision. In the IRR method, a project is adopted if its IRR is greater than the company's minimum required return, also known as the cost of finance. The minimum required return represents the cost of raising capital for the company, considering the cost of issuing bonds or issuing new stock. Flaw of the IRR method. Cannot compare different length projects. One of the major flaws of the IRR method is that it cannot directly compare projects with different lengths, such as a 5-year project and a 10-year project. This is because the IRR does not consider the timing of cash flows beyond the project's life. As a result, projects with higher IRRs may seem more attractive, even if they have shorter durations and potentially lower overall returns. Importance of understanding the flaw. The inability to compare projects with different lengths is a significant limitation of the IRR method, and it can lead to biased investment decisions. A project with a higher IRR may appear more appealing, but it might have a shorter life and, in turn, generate lower total cash flows compared to a project with a lower IRR but a longer life. Additional considerations. To address the flaw, businesses should supplement the IRR method with other capital budgeting techniques, such as the net present value NPV. The NPV accounts for the timing of cash flows and considers all future inflows and outflows, providing a more comprehensive evaluation of the project's profitability over its entire life. By using multiple methods, companies can make more informed decisions and ensure they are investing in projects that align with their long-term financial objectives. IRR method. The IRR method is like figuring out how much profit your project will make each year, just like the yield of a bond tells you how much money you make each year from the bond. It's like finding the magic interest rate that makes all the money you make in the future equal to the initial cost of the project. Example: imagine you have a special project and you spend $500,000 to start it. Now, each year, the project makes some money, but we don't know the interest rate yet. Let's see how much money it makes each year and find the magic interest rate. Year 1. The project makes $115,000, but we don't know the interest rate yet. Year 2. The project makes $150,000, but still no magic interest rate. Year 3. The project makes $175,000, but we're still searching for the magic interest rate. Year 4. The project makes another $175,000, and we're getting closer to finding the magic interest rate. Year 5. The project makes $125,000, and now we found the magic interest rate. The magic interest rate. The magic interest rate that makes the project's cash flows equal to the initial cost is 24%. It's like the yield of the project. Minimum required return. Now we need to compare the magic interest rate to the minimum required return set by the company. If the company's cost of raising cash, like getting money from bonds or stock, is 10%, and the magic interest rate is 24%, the project is good because it makes more money than what the company needs to pay to raise cash. Flaw of IRR method. The IRR method is helpful, but it has a flaw. It can't compare projects of different lengths. For example, if you have a 5-year project and a 10-year project, the IRR method can't directly tell you which one is better because they have different lengths and more cash flows over time. In summary, the IRR method is like finding the magic interest rate that makes your project's future money equal to the initial cost. It helps you see if your project is a good investment compared to the cost of raising money. But it's not great at comparing projects of different lengths. It's like finding the magic interest rate that makes your project a success. NPV method. The net present value NPV method is a capital budgeting technique used to evaluate the profitability and financial viability of an investment project. It calculates the present value of all future cash inflows generated by the project and deducts the initial investment cost. The result is the net value, positive or negative, of the investment in today's dollars. Calculation of NPV. To calculate the NPV, we discount each future cash inflow back to its present value using a specified discount rate. The discount rate represents the company's cost of financing, which includes the cost of raising capital through bonds or issuing new stock. After discounting all cash flows, we subtract the initial investment cost from the total present value to find the NPV. Adoption decision. In the NPV method, a project is adopted if its NPV is greater than 0. A positive NPV indicates that the investment is expected to add value to the company, as the present value of cash inflows exceeds the cost of the investment. Thus, a positive NPV signals that the project is financially attractive and should be pursued. Importance of NPV method. The NPV method is considered one of the most preferred and widely used capital budgeting techniques for several reasons. Comprehensive evaluation. NPV takes into account all future cash inflows and outflows over the project's life, considering the time value of money. This makes it a comprehensive measure of the investment's profitability and financial impact on the company. Considers cost of financing. The NPV method uses the company's cost of financing discount rate to discount cash flows. This ensures that the evaluation is based on the company's actual cost of capital, making it a more accurate representation of the investment's true value. Comparing different projects. Since NPV considers cash flows over the entire life of the investment, it allows for a direct comparison of projects with different lengths. This feature is crucial when companies have to choose among multiple investment opportunities. Maximizing shareholder wealth. By adopting projects with positive NPVs, companies are making decisions that are aligned with maximizing shareholder wealth and creating value for the business. Importance of making informed decisions. Capital budgeting decisions have a significant impact on a company's long-term success. Making informed choices about which investment projects to pursue is crucial for allocating resources effectively, managing risk, and achieving growth and profitability. By using the NPV method, companies can make more reliable and objective investment decisions, ultimately contributing to the financial health and sustainability of the business. NPV method. The NPV method is like figuring out how much money your project will make in today's money, considering the cost of financing. It's like comparing how much money you will make with the project to how much money you spent to start it. Example: imagine you have a special project and you spend $500,000 to start it. Now, each year, the project makes some money, but we don't know yet if the project is a good idea. Let's see how much money it makes each year and find out if it's a good investment. Year 1. The project makes $115,000, but we need to check if it's worth it in today's money. Year 2. The project makes $150,000, and we need to see its value in today's money. Year 3. The project makes $175,000, and we still need to figure out its value in today's money. Year 4. The project makes another $175,000, and we keep checking its value in today's money. Year 5. The project makes $125,000, and we're almost there. Net present value NPV. Now we use the firm's cost of financing discount rate to see how much all the future money is worth in today's money. In this case, the discount rate is 10%. We find the present value PV of each cash flow money made each year and add them up. The total is $557,135. The NPV is like finding out how much more money you made from the project than what you spent. In this case, the NPV is $57,135. Adopt or reject. Since the NPV is positive more than zero, it means the project is a good investment. You made more money from the project than what you spent, so you should adopt the project. Benefits of NPV method. The NPV method is helpful because it considers the cost of financing the company's way of getting money and tells you how much the project is worth in today's money. It also allows you to compare different projects, even if they have different lengths or amounts of cash flows. In summary, the NPV method is like finding out how much money your project is worth in today's money. It helps you see if the project is a good investment compared to the cost of getting money. It's like knowing if your project will make you richer in the end. Decision-making under uncertainty. Decision-making under uncertainty occurs when there is limited information or predictability about future outcomes, especially in the context of investment projects. Projected future cash flows are uncertain, and they may turn out to be either too high or too low compared to the actual results. To account for this uncertainty, managers use scenario analysis to test alternative projections and make informed decisions based on different potential outcomes. Scenario analysis. Scenario analysis involves developing multiple scenarios based on different assumptions about future events and their potential impact on the investment project. Three common scenarios considered are: pessimistic scenario. This represents a situation where things go worse than expected. It involves assuming lower cash inflows and higher costs or risks. Forecast scenario. This represents the most likely or expected outcome based on current information and estimates. Optimistic scenario. This represents a situation where things go better than expected. It involves assuming higher cash inflows and lower costs or risks. Importance of scenario analysis. Scenario analysis is important for several reasons. Risk assessment. It helps managers identify potential risks and uncertainties associated with the investment project. By considering different scenarios, they can gauge the project's resilience to adverse conditions. Decision-making insights. Scenario analysis provides a range of possible outcomes, allowing decision-makers to make more informed choices based on the project's performance under different circumstances. Sensitivity to assumptions. It reveals how sensitive the project's feasibility is to changes in key variables, such as sales volume, costs, or interest rates. This insight helps managers focus on critical aspects that significantly impact the project's success. Risk aversion. The decision to accept or reject an investment project may vary depending on the manager's level of risk aversion. A more risk-averse manager might prioritize scenarios with a higher chance of success, while a risk-tolerant manager may be willing to take more chances with optimistic scenarios. Discount rate. The discount rate is the rate used to discount future cash flows back to their present value. It reflects the company's cost of capital and the opportunity cost of investing in a specific project. Importance of the discount rate. The discount rate is crucial because it accounts for the time value of money. Future cash flows are worth less than present cash flows, and the discount rate helps convert all cash flows to their equivalent value in today's terms. A higher discount rate would place more emphasis on near-term cash flows, while a lower discount rate would give more weight to cash flows further in the future. In conclusion, decision-making under uncertainty requires a thoughtful analysis of different scenarios and their potential impact on the investment project. Scenario analysis helps managers understand the risks and potential outcomes more clearly, leading to better informed investment decisions. Additionally, the choice of the discount rate plays a significant role in evaluating future cash flows in present value terms, ensuring that managers consider the time value of money while making their investment choices. Imagine you have a lemonade stand, and you want to decide whether to buy a new fancy lemon squeezer. But here's the catch. You're not sure how much money you'll make in the future, as your sales could be different every day. It's like trying to guess how much money you'll earn when selling lemonade in the future. Now, to help you make a good decision, you can do something called scenario analysis. It's like playing What If. In scenario analysis, you come up with different possibilities for the future and see how they might affect your decision. Here are 3 scenarios we can think about. 1. Pessimistic scenario. This is when you expect things to go not so great. Maybe it's a rainy day and fewer people come to buy lemonade. So in this scenario, you assume your future earnings might be lower than usual. Example, you estimate you might sell only 10 cups of lemonade on a rainy day, and each cup earns you $1. So your total earnings would be $10. 2. Forecast scenario. This is your best guess, like making an average prediction based on your past sales. It's like saying, I think this is what will most likely happen. Example, you estimate you might sell 20 cups of lemonade on an average sunny day, and each cup earns you $2. So, your total earnings would be $40. 3. Optimistic scenario. This is when you imagine things going super well. Maybe it's a hot day, and lots of people are thirsty, so you sell more lemonade than usual. Example, you estimate you might sell 30 cups of lemonade on a very hot day, and each cup earns you $3. So, your total earnings would be $90. Now, since we're not certain which scenario will come true, it's essential to be careful about the decision. If you're someone who doesn't like taking big risks, you might choose the pessimistic scenario as the basis for your decision. This way, you plan for the worst and hope for the best. On the other hand, if you're feeling more confident and willing to take some risk, you might pick the optimistic scenario as the basis for your decision. This way, you aim high and hope to earn a lot. Also, there's something called the discount rate. It's like considering how much money you'd need in the future to buy the lemon squeezer. Since money in the future is not as valuable as money today, you could use the money today to do other things. You discount the future money to its present value. To decide whether to buy the squeezer, you compare your estimated earnings based on one of the scenarios with the cost of the squeezer. If the discounted future earnings are more significant than the squeezer's cost, you might decide to buy it. Otherwise, you might choose not to buy it. Remember, the future is uncertain and things might not turn out exactly as you expect. But using scenario analysis and considering your level of risk aversion can help you make a wise decision for your lemonade stand.